Select 50 Fund Focus. I'm joined today by Dan Roberts, who is the manager of the Fidelity Global Dividend Fund. Thanks for coming in, Dan.
Thank you for having me.
Let's start with the name of the fund then, the Global Dividend Fund. Obviously we in this country are pretty much familiar with dividend funds, but why global? What's the advantage of a global approach?
I guess simply put, it's a greater opportunity set. So if you think about investing in a country fund, you tend to get maybe 200 or 300 opportunities or a universe of 200 or 300 stocks to choose from. Globally, there's probably 10 times that number of stocks. So much more opportunity to add value by picking the right stocks within a sector, but also potentially gives you access to sectors that may be underrepresented in a local index. So for example, in the UK we have very little exposure to the tech market. A lot of tech stocks tend to reside in the US or Asia. If you're an Asian investor, you don't have much exposure to healthcare because a lot of those big pharma stocks are in Europe and the US. So it enables you essentially to create a much better balanced portfolio and avoid some of those portfolio skews that you do get in country funds.
Okay, all right. So let's just talk about your approach to investing then. What's your starting point? Do you screen for stocks? A lot of analysts at Fidelity, do you use their input as well?
Yeah, it's a good question because I guess the flip side of what I just said is there are a lot of stocks to choose from, 2,500 stocks. Now, we don't set out with the aim of knowing each of those stocks in detail. I think what's key is to have a very clear idea of what you're looking for in an investment, what you're trying to achieve, and then to focus your efforts on identifying ideas which satisfy your criteria. And for us, I would put that criteria into two buckets: valuation support. We want to make sure we don't overpay for stocks. However good a company you invest in, if you overpay, you tend to dilute prospective returns in an investment. And then secondly, franchise quality or business quality. We want to make sure we're investing behind good, resilient businesses that we can depend upon, and where we can have a really good, strong conviction behind our assessment of what that company is worth. Okay, so
you mentioned there sort of what you look for in investment. So what matters to you? Are you looking for growth or, well, obviously income, dividend, but capital preservation, I guess, as well?
Yeah, if I take each of those in turn, so valuation, we tend to focus on cash-based valuation metrics is the first thing I would say. Companies can manipulate reported earnings, but it's much more difficult to manipulate cash, so we focus on cash. And I'd also say we focus on the longer term. It's all well and good looking at what a company's delivering today, but we want to think about the longer term potential of that business. Are they over-earning versus their longer term potential or under-earning? So some assessment there as well. So that's how we think about the valuation side. And then in terms of business quality, it's a range of metrics we look at. We're not really trying to reinvent the wheel there, but we'll look at things like return on invested capital, cash conversion, balance sheet strength, earnings persistence, and all of these things help to increase our conviction in, like I said, in what we think the company's worth, and ultimately what we would be prepared to pay for that stock within the equity market.
And it's quite a focused fund. I think you've got about 50 stocks in the portfolio. Why is that?
Yeah, well, the strapline we use there is the right balance of conviction and diversification. We don't want to own so many stocks that we can't keep on top of all of those holdings, but at the same time we want to have an adequate level of diversification in the portfolio, and we think 50 stocks, give or take, it might be 45, it might be 60, we're not religious about it, but roughly 50 stocks is the right number to enable us to achieve that.
Now, a key challenge for income investors is to avoid what are called value traps. So these are stocks which look cheap, maybe they have a high dividend yield, but there's a good reason for that. So how do you avoid those kinds of companies?
Yeah, it's a strong focus on the sustainability of the dividend. So you're right, we don't automatically allocate capital to the stocks with the highest yields in the market, because often that yield can be a sign of stress in the underlying business and a precursor to a dividend cut. So we spend a lot of time thinking about the relevance of the business model, whether it's susceptible to potentially technological disruption, whether the historic business model is still relevant on a forward-looking basis, the strength of the balance sheet, where the company is within its own cycle. So we think about all of those things when thinking about the sustainability of the dividend, and all of that ultimately helps us to avoid what you just called a value trap within the market.
And, styles come in and out of fashion, and I guess if you look back over the last 18 months or so, then there's been a focus in the market on cyclical stocks which will benefit from growth in the economy. How have you fared in that environment? And is that changing? Maybe today's environment is better for you than it has been.
Yeah, well, the short answer is it's been a difficult environment for us on a relative basis, at least. On an absolute basis, we've made good progress. But a lot of stocks we own within the fund we like because they're relatively immune to the kind of ebb and flow of economic growth. They can thrive under a variety of economic scenarios, but I guess the quid pro quo there is when economic growth picks up, they may not keep up with the more economically or cyclical stocks within economically sensitive or cyclical stocks within the market that you mentioned. So it's been a more difficult environment for us. The other thing we should mention, of course, has been tech within the marketplace, and maybe we'll come on to talk about that.
Well, let's talk about it now. Yeah, so because obviously tech has been a big driver of the market, and that's not a key feature of your fund, I guess, because they don't pay dividends.
Well, we do own tech, about 15%, so that's 15% of the fund is in tech, but it tends to be what I would call old tech. So the likes of Microsoft, Cisco, Oracle and so on, or cyclical tech, so the likes of TSMC, Taiwan Semiconductor Manufacturing Company, where we see reasonable valuations, still good growth, strong balance sheets, good return businesses, high return businesses. But we don't have the tech which you probably read about in the paper on a daily basis, which are the Teslas of the world, the Amazons, the Netflixes of the world.
The FANGs, yeah.
And these are the stocks where we really struggle as dividend investors. Many of them are consuming capital, not returning capital. So the payment of a dividend is really the last thing on their minds, and they trade at very high valuations, which we find difficult to justify. So they are pretty much absent from the portfolio, and as they've been leading the market higher, we haven't benefited from that kind of dynamic. So on a relative basis, again, that's been a headwind for the fund.
So let's focus on dividends and the prospects for dividends. I'm thinking both about the level of yields, but also the outlook for dividend growth.
Yeah, so if we think about dividends, it's really a function of two things: overall corporate profitability, and then the percentage of profits that companies or boardrooms choose to pay out. So first of all, overall corporate profitability, it looks high, quite frankly. It's been a great time for companies. And if you think about the big costs for companies, they've all been relatively muted over the last kind of decade, if you will. So interest rates are very low, tax rates have been falling, real wage growth has been pretty much non-existent in the developed world. Investment rates have been quite low as well. And all of that has really buoyed corporate profits. So corporate profits are quite high. I'm not sure how much better they can get. And then if we come to payout ratios, it really depends which region you're talking about. So in Europe and UK, payout ratios are up at 50%, quite high, perhaps a bit higher than we would ideally like. In the US, they're about 30%. In Japan, nearer 20%. So what that means is the prospects for dividend growth in regions like the US and Japan are clearly better. But you mentioned that the levels of yields, the quid pro quo there is that the yields in those regions are lower. So it's a trade-off between the two, and that's a trade-off we're constantly thinking about within the portfolio.
Dan, thank you very much for those insights. And if you'd like to find out more about the Global Dividend Fund, then search under Fidelity Global Dividend on this website. Thanks for watching.